In 2026, leverage has migrated into private credit, and a decade of low rates left risk spread through channels that are hard to see from the outside. The last time, leverage hid in plain sight and then surfaced all at once. 2008. This is that archive. This is an archive of the 2007 to 2009 global financial crisis. Documented market data only. Not a forecast, not investment advice. Chapter 1. The Setup. After the dot-com bust and the September 11th attacks, interest rates were cut to historic lows. Cheap money flowed into housing. US house prices rose year after year, and the belief took hold that they could not fall nationally. Mortgages, including subprime loans to borrowers who could not really afford them, were bundled into securities and stamped with AAA ratings. Risk was sliced, repackaged, and sold around the world. Chapter 2. The Leverage. Investment banks operated at leverage of 30 to 1 or more, $30 of assets for every dollar of capital. At that ratio, a fall of just a few percent in asset values is enough to wipe out the firm entirely. And the risk was tangled through derivatives that almost no one could fully map. When the housing assumption failed, no institution could be sure which counterparties were solvent. Trust is the system's real collateral. Chapter 3. The Cracks. Through 2007, subprime defaults rose. 2 Bear Stearns hedge funds collapsed. The French bank BNP Paribas froze withdrawals from funds exposed to US mortgages, often marked as the moment the credit crunch began. In March 2008, Bear Stearns itself failed and was sold to JP Morgan in an emergency deal for a fraction of its former value. The market treated it as the end. It was the warning. Chapter 4. September 2008. On the 15th of September 2008, Lehman Brothers filed for bankruptcy. Over $600 billion in assets, the largest bankruptcy in United States history. This time, there was no rescue. 639B. Lehman Brothers assets. Largest U.S. bankruptcy ever. The system seized, money markets froze, short-term funding vanished, and the insurer AIG was bailed out for around $180 billion days later. The fear was a chain reaction of failures. Chapter 5. The Response. The backstop was enormous. The U.S. Congress passed a $700 billion bank rescue. The Federal Reserve cut rates to near zero, launched emergency lending facilities, and began quantitative easing, printing money to buy assets. It was not enough to stop the damage, only to stop the collapse. Stock markets fell about 57% from their 2007 peak before bottoming in March 2009. Chapter 6. The Legacy. The aftermath rewrote the rules: Dodd-Frank, higher bank capital under Basel III, regular stress tests. But it also entrenched too big to fail and made central bank intervention the permanent expectation in every crisis since. The era of quantitative easing and near-zero rates that defined the 2010s began here, as emergency measures that never fully went away. Chapter 7. The Pattern. The pattern the record shows. 1. Cheap money inflates an asset assumed unable to fall. 2. Leverage plus opaque derivatives spread hidden risk. 3. The assumption fails. Trust and funding freeze. 4. Massive backstop stops collapse. Entrenches the next one. This archive does not predict whether today's hidden leverage will surface the same way. It documents what happened the last time the system was declared safe, right before it wasn't. The archive stays open. This is what the historical record shows.